Talk, the podcast where we keep it real in real estate and we take the mystery out of the real estate and home loan industry. I am your host, Luna Petty, your friendly neighborhood mortgage broker and straight talking guide to the real estate market. Whether you're a first time home buyer or a seasoned investor, whether you're a real estate professional or just curious about the real estate market, you've come to the right place. Each week, we share expert insights and real tips and strategies to help you win in real estate. So get comfortable and let's get started with your real talk, where we keep it simple, straightforward, and 100% real with our guest, Dan Harkey. Welcome to the podcast, Dan. Tell the audience about yourself and how you got into the real estate industry.
Well, in the early 70s, I was a teacher and I started selling real estate part-time, and it was very successful to the point where I was making about 10 times more part-time than full-time teaching. Then I started a mortgage company almost immediately, and then an escrow company, and then a property management company, and a general insurance agency, and then uh, a home repair company. So I had everything under my belt, right? The problem was at that time, I was a better salesman than a manager, and managing all the people kind of drove me nuts. So I basically sold off each subset of that and held on to the one thing that I enjoyed the most, and that was the mortgage business. I think that was around 1985.
Okay.
So from 1985 until now, I've been essentially in the hard money lending business. Um, and with that, I've given about 350 educational seminars. I ran the California Association of Mortgage Brokers Ed Committee for about 15 years. And I've written dozens and dozens of articles, maybe 1,500 pages of material about real estate and real estate finance. So I feel competent to be here and answer questions for people as an educator. I might also refer your viewers to my website, danharkey.com. And what you're going to find there is a treasure trove of my educational articles. Okay. Uh, I actually started writing a book, an overview of the private money lending industry. And when I got to 1,000 pages, I thought, this is not going to it's not going to be effective cost-wise, and people aren't going to read it. So I started then putting little tidbits of that on my website. And so you'll find pretty much all aspects of this on my website. Also on the website, if you click on there and you go on there, you'll be able to look up keywords or key topics in articles. For example, if you want liens and encumbrances on real property transactions, or if you want intercreditor agreements, or if you want leases, or if you want environmental issues or techniques. My my website has various components: um, real estate, real estate technical, um, humor, which is Dan's humor, kind of a sarcastic form of humor, very short. Um, how to reinvent yourself in your business enterprise, and which is personal growth, pretty much personal growth. I think I have about close to 50 articles on that. And then opinion and perspective. I have about 100 of Dan's opinion articles. And then I have the California economy, and then I have the national economy, which I call the American enterprise. So depending on what your subject matter is, you can go on there and you can forage around and see what.
You're like an encyclopedia on one website for all things.
Yeah, yeah, and with that, it's as of today, about 1 week from now, it'll be complete. Okay, and then I've got to populate it with another 300 articles. I also write an article pretty much every day and put it on LinkedIn. I post on Facebook. Uh, pretty much every day, and I send out about 175,000 email articles per week.
So you're very in tune with what's happening in the market. So what do you see? Well, first, let's explain to the audience what's the difference between private money lending and or hard money lending and the traditional lending platforms that people see when they talk to a bank or a lender and they talk about things like conventional and FHA loans. So what are the differences there?
Well, institutional loans, as a subset, would go to either a bank or it would go to a securitizing company that would have a large line of credit, and they would fund those loans into that line of credit, and then they would sell them to uh, somebody like Fannie Mae or Freddie Mac, or in some cases, sell them to life insurance companies and manage the servicing until fruition. Okay. Those people have underwriting standards that are, I wouldn't call it onerous, but they're pretty picky, and it takes
Hmm.
quite a long time to get them enough information to close their loan transactions. And of course, there are lower rates and better terms. The alternative industry called hard money slash private money are uh, situations that don't qualify for institutional loans, traditional lending. And there are dozens of reasons and there are dozens of circumstances that come to us where we will pre-underwrite a transaction and we will then agree to, when I say we, the industry, someone
Right.
in our industry will agree to say, the industry participant wants your loan, we like it, we're going to issue you a letter of interest. And once you sign that letter of interest and once you pay for an appraisal, then we're going to start a loan processing sequence, okay, which means collect your financial data. And the financial data collected in the private money loan business is much less than um, in the institutional. For example,
Hmm.
uh, the private money lending industry might take a loan application, a credit report, and a background search from a company like LexisNexis, and the most recent payment statement, and 3 months worth of bank statements. With that, all of that, uh, the processor can determine whether or not the borrower can make the payments. Now, that's a lot less than an institutional lender. Uh, and generally, private money lenders don't really look at tax returns, whereas institutional lenders do. So that's pretty much it.
Hmm.
Now, the other thing about private money is in the institutional side, there's an institutional bank in the background funding these loans, or
Hmm.
a massive organization like Fannie Mae and Freddie Mac, um, or the US government, or a giant bank, right? In the private money lending industry, you have private parties that fund the loans as lenders, okay? Um, you might have, let's say Dr. Jones is an example. Dr. Jones retired and Dr. Jones has a couple of $1 million. Dr. Jones is fictitious. And rather than investing in the stock market or putting his money in US treasuries or putting it under the blanket, he approaches somebody who specializes in the hard money lending industry and said, "Hey, I would like to invest my money. The yields that he's going to get will be, 5% above uh, B of A prime, for example, or Wall Street prime. In other words, at today might be 10%, let's say. And those fluctuate, but they're always more than he can get in comparable, when I say
Hmm.
always, in most cases, in comparable investments with comparable risk. And that investor then is relying on the mortgage broker to build a package that provides him or her with the material facts that go with that transaction so that that investor can make the decision to invest. Okay. Once that investor invests in a trust deed,
Mhm.
then and the transaction closes, then it becomes somewhat of a passive investment for them in that a loan servicer takes over the process and collects the monthly payments and forwards the payments to the investor. Okay. All along there are licensing and regulatory requirements, and so it's a highly sophisticated process, and there's software packages designed to flow from excuse me, from underwriting to um, closing the loan to loan
Mhm.
servicing and loan payoff. Okay, now Dr. Jones might also have a pension plan or a 401k.
Mhm.
So he might have the Dr. Jones family, which he can invest, his family trust. He might have a 401k or a pension plan. He can invest for that entity as a trustee of that plan. And he might even have children that he's provided money for, so he can invest for those subsets of people. So Dr. Jones, given his economic strength, may have 5 different ways that he holds title and invest in the same transaction. Okay. And at the same token is when a person invests in a trust deed, what they're getting, a trust deed is a security. Okay. It's not a hard asset. You understand the difference between that?
I do, but maybe some don't. You want to go into
Oh,
that?
sure. Okay. Well, that's an important aspect of our business.
Yeah.
When you have a piece of real estate, you can kick the tires, so to speak. You can visit it, you can paint it, you can finance it, hypothecate it, tear it down, rebuild it. It's a hard asset. Okay. Anything that's called an evidence of indebtedness, okay, is a security. Okay. And it's basically written agreements out of the 1929 to 32 Securities Acts, okay, that defines what a security is. Well, security is really personal property. So the difference we're talking here is real property and personal property. So when an investor invests in a trust deed, they have a piece of personal property backed by a sequence of disclosure documents and a trail of the money going into the broker's trust account. And at the end of the closing, then they'll get a recorded trust deed. They'll get a promissory note from the borrower. They'll get a title report with their name on it as a named insured. And then they will sign up an agreement with the uh, mortgage broker to service the loan. Okay, so they're at that point, then they own the asset, and they're saying, okay, Mr. Mortgage Broker, or as an alternative, a dedicated servicing company that's not a mortgage broker, I'm going to give you these 17 delegated rights. Okay, I'm going to delegate to you the authority to communicate with my borrower, uh,
Mhm.
to collect the payments, to put the money in your trust account, to send that money to me at less your servicing fee. If the borrower doesn't pay on time, you have the authority to contact him. You have the authority to file a notice of default if they are routinely late. We're instructing you to check on the property taxes to make sure they're current. We're instructing you to check on the homeowners association to make sure that's current. And we're instructing you to make sure that the insurance policies are current.
Mhm.
Okay. And we're instructing you to keep us um, with a level of knowledge without being an active manager of this trust deed, and so that we understand what's going on. And that's what we do. Now, that private investor is a single party. Okay. If you get a bunch of private investors, they may, as a little alternative, they may form an entity. First of all, if you have a private investor invest in trust deeds and you have party A, party B, party C, and party D, right?
Mhm.
They own fractional shares of that trust deed. Okay. Maybe 20%, 30%, as what's called tenants in common. They're
Mm.
like partners, but it's called tenants in common, up to the point where there's 100% ownership in that trust deed. Um, they don't usually communicate with each other, they communicate through the broker.
Mhm.
An alternative method in the industry is a securitized mortgage pool where somebody will form an entity like a limited liability company. It's like almost like a little mini bank.
Yeah.
Okay. And they'll do the limited liability company documents, and that will define that we're going to take in so much money, and we're going to then loan that out. The limited liability company will be the lender and the
Mhm.
limited liability company, and you'll get distributions of profit from the limited liability company, and you'll get reporting, and you'll get an annual statement um, showing how much you've earned for tax purposes. So that's an alternative. I've had the experience of writing a $250 million pool offering. And I've also had the experience of writing a $500 million SEC registered pool offering for, for a public offering that's registered.
Well, let me back up real quick, Dan, and just let me make sure I break down what you just explained. So the private money lending can come from either an individual who has funds, whether it's their own funds or their family's funds, and they can invest that. They can put together all of the appropriate legalities so that they so that they can legally provide that as funds available for an individual who needs a private money loan. And for me, for real estate, most of my clients who need private money are usually real estate investors who are looking to purchase a property and either buy and hold or buy and flip. And they need that hard money loan as a temporary umbrella or bridge to their next loan most of the time. And then you're saying the other way, Dan, that people are investing as on the investment side of private money is they're pulling funds from multiple individuals together and they're doing all of the legal requirements to be able to lend that money as one pool from lots of individuals.
Correct.
Okay, got it. Okay. And then from there, you were going on to say that you've pulled together. So can I, as a mortgage broker, just say, hey, I want to get all of my clients who have a net worth of $1,000. Everybody put in their $1,000 and we're going to create a giant pool to be able to lend on a private money lending platform, or how complicated is that? Or
Well,
not complicated?
no, 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 no. Complicated is a good word. Complicated, because you have an overlay of federal securities and state securities. So you start out with a federal exemption that you work with. You always have to have a federal and a state exemption. So the complication comes with this. If you're going to create an entity, or if you're going to invest in trust deeds, here, let me turn that down. Can you hear?
A little bit, a little blue, but that's okay.
Okay, somebody is okay. If if you're going to create an entity, or if you're going to hold yourself out as making and arranging, you have a regulatory requirement. Okay, all this from the business and professions codes to the securities regulations of California. So there's an exemption for these kind of things. Okay. So if you're gonna do that, you need somebody that knows and can direct you to make sure that this is done correctly. I could start citing code sections to you and then you'd go to sleep. And I certainly have the capability of sitting here and spewing out code sections, but that's extremely important. If your viewers actually ever want to just call me and let me direct them, or call you and you call me and direct them, I'm perfectly happy to do that. To refer them to a source that can assist them.
So are people usually setting up these entities with the assistance of an attorney?
Yes, when I say I wrote it, I wrote it. I wrote these. Okay, I wrote these offerings myself to start with. But then, because I'm not a lawyer, I went to a securities lawyer and a real estate lawyer and explained what I was trying to do and had them go through it and make sure it was compliant and make sure that I filed the appropriate paperwork. Okay. Um, and I've done Reg D offerings, I've done Rule 147 offerings on a federal basis, and at a state level, I've done what's called multi-lender transactions, which is 25102.5 exemption. And then that's up to 10 investors. If you have 15 investors, the exemption would be 25102F. Those are, you don't really want to get into that. You want to just rely on somebody who does that,
Yeah.
right? And we could, if you wanted to have a webinar on the technical aspects of this, I could do it, but I think at this level, it's a snoozer.
Well, what are some of the differences between if somebody wanted to pull what funds they have available, do they have to have a minimum net worth in order to invest in pools like this?
Yeah, yes. They should have a net worth of at least 250,000 or above, and what's called an accredited investor, essentially a millionaire type investor. And that's subject to the definition of an accredited investor on a state level. So this is not for retired people who have 500 bucks, right? That's that's a whole different industry of that kind of an investor.
Mhm.
The presumption is that in this industry that the borrower, I mean, sorry, the investor has a background of knowledge and experience that they can make the economic decision to invest for their interest, but also understand that there's risk.
Mhm.
Okay. And a lot of times, smaller investors, they'll invest a little blindly, but they don't really understand the risk.
Mhm.
So, yes, you should be worth, and then also let's say that you're worth 2 million or 5 million, doesn't even make any difference.
Mhm.
And let's say you have $1 million in liquid assets. You wouldn't want to put all of that in one trust deed. You
Makes
could,
sense.
you could,
Mhm.
you could say, hey, I have $1 million. I want to put that in one trust deed. I want to own that trust deed. I want to keep the original note and deed trust in my safety deposit box or my vault at home. But the more prudent way was to say, I would like four different $250,000 portions of investments, which gives you a level of diversity. Okay. You'd have different borrowers, different property types, different locations, and different due dates.
Mhm.
So that at any given time, if there's a payoff, you're not sitting there with a dead money in your checking account not earning interest.
Yeah.
So diversification is a very important part
Yeah.
here.
What do you see different at going into 2025? You've been in the industry and watching it since the 80s. What do you see different in the private lending sector for 2025 that people should either look out for or maybe look forward to?
Well, first of all, I started in the hard money business in the early 70s. I mean,
Hmm.
that's the reason I ended up in hard money is because I was doing them all, because it was the most fun. And when somebody wanted a loan, the length of time to process them was 2 weeks rather than 2 months, right? So
Yeah.
I was motivated by a quick turnaround. What I see going forward, well, first of all, let's come back to where I see going forward. Let's talk about why some examples of why people need these loans, and then we'll come back to what I see going forward.
Okay.
Um, if you had a partially completed building and you ran out of money, okay, you may need some extra money. Okay, let's say you had a building that was going to be worth 2 million, and you had $1 million first trust deed, and you needed 200,000 more to complete it. You would then approach a hard money lender who would loan you a junior lien behind the senior lien. Okay. And it may be very short term, it may be just for 1 year, and that would give you the capital to complete the
Your
project.
construction.
Yeah, yeah,
Hmm.
the property to either refinance it, sell it, or somehow take that pay that loan off. Okay. Let's assume that you had a partnership dissolution and you get in litigation with a partner, and the settlement agreement suggests that you needed $250,000 to pay off that partner. Okay. So that's another reason that you then would come to a private money lender. Or let's assume that you had a few bad months in your business. Okay. And let's assume for 10 years, then all of a sudden something like the COVID fiasco comes along and your financials are lacking, but you've got them straightened out, and but you need two or three, $400,000 to pay off everybody, so you can get back in front of this and then go forward, right? Uh, let's assume that you have a divorce, okay? Now, and you need money to pay off an ex. That is a consumer loan, and some people in the business will do consumer loans, and some people will not. But that's a subset of this business. So the distinction there is a consumer 1 to 4 and non-consumer 1 to 4 or business purpose loans. Okay. The predominant um, purpose of this industry are business related loans. It could be anything from shoring up a building, a seismic retrofit, right? A
Yeah.
rehabilitation of the building, an upgrade of the building, uh, solving any disputes. There's an example where a, a family has a parent that's not taking care of the building. Parents are old, elderly, and just kind of let things go.
Mhm.
All of a sudden, the kids figure it out, and then they need to come in, take control of the building and fix it up to either get it rented or to sell it. Okay, that's a purpose. There's also an example where the kids are the trustees of the trust, and the parents or a parent, whichever parent is left, if one is deceased, is in a retirement home, and so they have this asset. They need money to handle, let's say, grandma. Um, they need money to handle grandma or mom. And so they would come to a hard money lender and they might borrow money to pay for some of her um, stay in the retirement home, also to upgrade the building, to rent it or to sell it. Okay, so if you look at the number of reasons for hard money lender, it gets into the hundreds.
Absolutely.
Okay. And so I'm just telling you that the phone rings off the hook for most mortgage brokers. And the issue for those mortgage brokers are sifting through transactions that are actually doable as opposed to transactions that are not doable, meaning
Yes.
there's not sufficient equity in the property. The borrower is in default and has a notice of default and in foreclosure. Or if they pull a background search and a credit report, you find that this borrower has been negligent for years and years and years. And that lender doesn't want to take that economic risk of dealing with a flaky borrower, right?
Right.
Okay, so there you go. So now let's go back to um, where we go from here.
Yes.
If I look back in my period of time when houses were 25,000, and you know, interest rates were like 12, 14%, 10 points, 10 the point fee, right?
Mhm.
And up through the 80s, then we had a big giant inflationary spiral, and then up to 87, we had a crash where the stock market went down. But we've always had inflation rearing its ugly head. Okay. Inflation is 100% caused because government issues phony money.
Mhm.
Okay. 100%. It goes to the computer and it spits out 2 trillion or 5 trillion or 25 trillion and injects it into the system without any work, without any effort, with nothing. What that does is that erodes the purchasing power of everybody's dollars, right? And that's what causes the inflation. So, from a point when I was in college, I could go to McDonald's. I bought my Volkswagen for $2,000 brand new, and go to McDonald's for $1 and get a French fries, a Coke, and a hamburger. To today, everything has gone up, 500%.
Right.
Okay, so the problem we have is always inflation. Now, if you look at some of my opinion articles over the last 4 years, I've been pretty critical of government and the government enterprise and government employees and hiring people who make work for themselves, and their primary objective is to get subordinates who can do about as much as their boss, who does very little. It's a whole method of our government and the way it works. Okay, not across the board. And I've been fortunate enough to have a good friend as one of the senior auditors in the General Services Administration, and had many conversations about this. So, um, number one is if we can cut the size of government by 30 or 40%, we could get rid of our $3.5 trillion annual deficit. And remember, that deficit is paid by issuing phony money into the system, right? Okay, if we could get rid of that, inflation would go down. Okay, the economic engine would rear its head, and going forward, everybody would do much better because they wouldn't be chasing their lifestyle like most people are today. The unfortunate part of the common person today is they don't have enough money to buy 4 tires, and the
Right.
average consumer today is spends about 105% of their income, which means they're relying on credit cards, and then they're on a kind of a treadmill. You know,
Yeah,
it's
absolutely.
difficult. So the hard money business going forward, the whole hard money business does better in turbulent times. If there's more stability, we don't do as well. Okay. On the other side, but so I think what you're seeing today
Mhm.
is about what we're going to have for the next year in this subset.
Okay.
Uh, in the institutional subset, everybody wants to bring interest rates down, but as soon as interest rates down, that means everybody refinances their property and everybody refinances their corporate debt, and inflation rears its head. So you just have this constant grind. People are not aware that since 1913, 1913, when the Federal Reserve started, you could buy a full meal, five-course meal, and a drink for 10 cents. And today, since that time, inflation has gone up around 3,300%. Yeah.
Yeah.
And so you roll forward, nothing's going to change. Inflation is going to continue. The part of the problem is the number of people who demand that it stop, that this treadmill that the government has created stop. It's not great enough. At this point, 70% of the population of the United States relies on some form of transfer payments. And transfer payments could be welfare, Social Security, some form of retirement, or some form of special compensation like free lunches, free food, and that kind of thing. So we have what we have. If we can rein in expenses, I think we'll have a whole new dimension of dynamics in the private enterprise system.
Interesting. Dan,
Pardon?
I can go into so much detail, but I'm out of time. I really
Sure.
want to revisit this again. You're a treasure trove of knowledge, just when it, not only in the private lending industry, but I've read a lot of your articles. I receive them daily. I see them on LinkedIn, and I'm always come back. I always, after finish reading one of them, I always come back asking more questions about my industry, myself, what I'm doing, or what others are doing. So they're very thought provoking. So I encourage anyone who is listening to this to search for Dan Harkey, find him on LinkedIn, find his website, dive into some of his articles. You are going to find something in there that is going to be of interest to you. Dan, thank you so much for being a guest on my podcast. And I hope to have you back really soon so we can get into more of the weeds and more of the details and really educate people on where things have been, what they're doing, and even other more creative ways for people to invest their money, like in the private money lending sector.
Well, that's great. Thank you. Thank you for inviting me. Also, if they want to be on my article distribution list, which they would not get less than one a week, just go to my website and sign up.
Perfect, perfect. So go to Dan's website, sign up to get on his article distribution list. You will thank yourself later. Thank you again so much, Dan, for being on Your Real Talk, and I hope to have you on again real soon.
Okay, thank you.